Hi, I'm Brian Abbott. I'm Principal of SMSF Strategies. Now let's talk about contributions and getting money into the fund. This is probably some of the key criteria and certainly an area the Commission is looking really closely at these days, particularly now that the government has started to limit the amount of money that can go into a fund, either a deductible contribution or what we call an undeducted or non-deductible contribution. You see, with the changes of law that occurred on the 1st of July 2007, we've now got a position that effectively someone who might have many millions of dollars sitting in superannuation that is starting a pension inside that fund can have a pension side of the fund that's basically tax-free. They can invest how they want. Any income or capital gains that they earn on the pension side of the fund is effectively tax-free. But more importantly, when they take the money out, if they're over age 60, again, it is tax-free. If they then pass it on to their children, that's just get the assets and pass them out on their death, again, it is tax-free. So it seems to me that quite clearly the family super fund or the self-managed super fund is the smartest tax play in town. A family trust, and particularly most of you with accountants will have run into quite significant difficulties with family trusts recently. Family companies, partnerships or individuals just don't really cut it compared to a self-managed super fund, and there's a plethora of tax advantages. Now, it's great to have all those tax advantages, but the government's not stupid to simply allow open slather for particularly the well-off or the well-to-do putting $15, $20, $30 million in there to effectively hide the money from the tax and the commissioner. I mean, not many people understand that once you're inside one of these funds, if all you're really getting is tax-free income from the fund and nowhere else, that's you're hiding all your investments in there, you don't even have to lodge a tax return anymore. So the commissioner doesn't even know you exist, which is quite an amazing experience for many people, and has certainly been seen in Australia since 2007 by many people who have actually dropped out of the system because they've been taking tax-free super. But again, the money getting in, the commissioner is obviously starting to enforce the government's guidelines on the limitation. So we can contribute into super. Let's have a look at what the trust deed allows. Our trust deed, if you're using SMSF Strategies, trust deed allows three things, and we're really one of the only ones in the marketplace to do that. First thing is you can really contribute by way of cash, cheque or a promissory note. They're the simple things. They're the things that the Commission in his recent ruling on contribution said contribution can be all of these things. They're all to be treated as if they are cash. The second one is most important, is what we call an in-specie contribution. We get property such as shares, and instead of cashing them out, taking the cash, putting them in the super fund, we simply get the shares and we transfer them in specie. We do a legal document transfer, and your financial planner, your accountant or your SMSF advisor can effectively easily do that transfer. We transfer them into the superannuation fund. So I might have shares outside and I'll simply transfer them inside the fund. Why would I do that? Well, it's pretty obvious. When I get dividends, they're effectively tax-free in the fund, but when I sell the shares, any gain from the time I've transferred them until the time I sell them are basically tax-free if I'm using the pension side. So it makes a lot of sense to actually do our investing inside our self-managed superannuation fund. Let me give you some insights into Section 66 and more particularly the exceptions to the rule. First thing is you can transfer in listed shares. Anything that's listed or options on those can be transferred into our superannuation fund. Anything in a widely held unit trust, like a Westfield property trust, can be transferred in. If you've got a property syndicate of maybe 30 or 40 players, that can generally be transferred in as well. But you really want to talk to your accountant, your auditor, your financial planner, your specialist SMSF advisor in relation to that. Business real property can be transferred in. For those who really want to have a look at, the Commission's got a great, huge, in fact it's momentous, ruling on what is business real property. That can be effectively transferred into our self-managed super fund if it's owned by a family trust or a related party or members themselves. It includes, for example, if you're a property developer, land that's got DA approval on it, any office or commercial building. If we've got a doctor's surgery, provided there's effectively no domestic or living areas in there, can be transferred in. Farms are automatically can be transferred in. It makes sense to actually be transferring those farms into our self-managed superannuation fund. We've also got a position whereby residential property, if we can show that we're in a property management business, effectively we can transfer residential property in. If we can't show we're in a property management business, we might only have one or two properties, effectively we can't transfer that in. If you want to know a bit further, get in touch with your advisor on what residential property amounts to business real property, so they can all be transferred in. So again, cash, or we can transfer in specie, which is basically property such as farming property, shares, managed funds can all be transferred in. We've also got the ability now of what we call a deemed contribution. That is where, for example, an external party makes an expense payment on behalf of our superannuation fund. Let me give you a simple example. This year I've got quite significant insurance benefits sitting inside my self-managed super fund. For those of you who've seen me or heard me talk before, I've got two funds, two sets of children. I've got a blended family, Amrita and myself, one set of children from her marriage, previous marriage, Amrita and myself, and children from previous marriage in a separate fund. We've got effectively two funds with insurance policies in both funds. Now, what we could do if we wanted to, our company could make a contribution into our superannuation funds, which is a tax-deductible contribution, or called a concessional contribution. That is then taken by the trustee of the fund. The trustee of the fund then has a meeting, does its minutes, then goes and pays the insurance policy premiums. Or alternatively, which is a lot easier, and again the Commission's come in its ruling saying this, which to me is a better way of administering, and thumbs up for the Commissioner on this one, is that my company can simply pay the insurance premiums on behalf of the trustee of the superannuation fund, and then that's then treated as a deemed contribution. So it's treated as if the company has made a contribution on my behalf into the superannuation fund, a concessional contribution. So again, there's some great opportunities in doing a lot of this deeming. For example, if I give you a bit of a segue into the borrowing rules, one of my favourite borrowing strategies is for a related party such as myself or my family trust to act as a lender where we are borrowing to invest in property. Makes a lot of sense. So what happens though, when the related party acts as lender, what we can have is the related party can forego some of the loan or forgive some of the loan. To the extent it forgives a loan to the trustee of the self-managed super fund, the Commission states in its ruling that is a deemed contribution. Again, very flexible way of transferring property and loans and assets into our self-managed superannuation fund over time. There's a lot of sophisticated strategies which you can see on the SMSF strategies website on that, or sit down and chat with your financial planner, accountant or specialist advisor in that regard. But anyway, just coming back to that deeming these deemed contributions, just a couple of things. First off, you need to make sure that trust deed has that. The SMSF strategies trust deed is one of the only deeds in the marketplace that allows those deemed contributions to coexist. In terms of contributions, in 2007, as I said before, the government started to put some brakes in there, and of course the Commissioner is there to enforce those brakes, and he's doing it very diligently and very hard-heartedly at the moment. But still, that's what the Commissioner is paid to do. He really doesn't have much discretion in this regard. So the way the rules work is that if you're over 50 at the present point in time, particularly up to 2012, $50,000 of deductible superannuation contributions can be made on your behalf each and every year. So for example, in my particular instance, I'm over age 50, $50,000 of tax deductible contributions could be made on my behalf. What will happen is the trustee of the fund then tells the Commissioner of how much of these tax deductible contributions are made, and that's classified as a concessional contribution. When the concessional contributions come off, it goes off to the Commissioner, he then assesses me for it. If I go above that $50,000 limit, then I get assessed at 31.5% for any excess. Importantly, if we got to start to look and monitor that, I don't want to really go into an excess position. So it means that if my company is making an insurance premium payment on my behalf that's now a deemed contribution, I've got to still be very careful about my salary sacrifice, my employer contributions, to make sure I fit within that $50,000. Remember, it's cash, promissory note, cheque contributions, also includes in specie and now these deemed contributions. They all have to fit within those particular guidelines, those concessional contribution caps, otherwise you're up for an excess. If I'm under age 50, then you've got a position where effectively it's only $25,000, which is a concessional contribution cap. Quite apart from concessional contribution caps, there's also caps for making undeducted or non-deductible or after-tax contributions into super. For example, I could transfer shares into a fund and those shares might be valued at $200,000. Then effectively, each and every year, I'm only allowed to transfer in $150,000 worth. The extra $50,000 will be classified as an excess non-concessional contribution. Being over my cap effectively means that I'm up around about a 45% tax penalty, which really stings quite a lot. So I've got to make sure that I keep within my non-concessional cap of $150,000 per annum. That applies whether I'm under 50 or above age 50. What we've also got though is there's special rules for people under age 65 that provided they commence at under age 65, they can do a 3-year averaging rule. So where I had before, I put in the $200,000 of shares, undeducted contributions, it would now mean that these rules, these averaging rules, come into play. So my accountant or my administrator will be tapping my shoulder saying, look, effectively what you've got now is you've gone above your cap, you're not going to be up for excess concessional contributions, but what it would mean, I've used 200 of my 3-year bring forward. My 3-year bring forward of 150 means that I've got $450,000 cap, I've used 200, it means over the next 2 years I can't go above $250,000, or otherwise I end up with excess non-concessional contributions that's taxed at 45%. So that's the 3-year bring forward rule, can apply at any time up to age 65. Just while I'm there, we just might talk about the contribution rules. Contributions can be made under age 65 on behalf of anyone, but between ages 65 and 75, effectively you need to be in a position of working 40 hours over a 30-day period any time during an income year. If that's the case, effectively a concessional or a non-concessional contribution can be made. That's, remember, the deductible or the non-deductible. The 3-year bring forward rule never applies to anyone if they're commencing or trying to commence that rule after age 65. So they're the contributions. There's a couple of other points. A rollover, I might have money sitting in a superannuation fund that can effectively be rolled over into another superannuation fund. So it could be rolled over from a public offer or retail fund, industry-based fund, into my self-managed superannuation fund. That rollover is not treated as a contribution per se for concessional rules or non-concessional rules. Effectively, you don't have to meet the rules. If you're under age 65, you're okay. Or up to age 75, you find that you can't roll over once you turn over age 75 if it's a rollover of a CGT small business concession. That's a separate thing that your accountant will advise you on. We've also got an ability to transfer benefits or roll over benefits from an offshore fund like a UK fund, a US fund, a Malaysian fund directly into our self-managed super fund. There's some quite good concessions there available if you are rolling those over, but you really need to have a specialist. If you really don't have a specialist or you need someone who can help you in this, you'll find on our Find Advisor section inside the SMSF Strategies website, there's a whole lot of accredited SMSF Strategies advisors. Alternatively, you can just simply email or contact us directly from the website. Anyway, that's getting our money into the fund. What we need to do now is go on a little bit further and have a look at how that money can then be invested and possibly the tax consequences on that. It's Grant Abbott from SMSF Strategies signing off.